Welcome to another episode of Policy and Profits. I'm economist E.J. Antoni, and I am not joined, very sadly, by the one, the only, the great trader extraordinaire, Anthony Esposito, who is traveling this week. He's doing great work for his fund, Ascalon, and we look forward to having him back next week. So we're not going to do much on the profit side this week. Instead, we're really just going to focus on policy. It's going to be a short episode, but we're going to give you the latest on what's going on at the Fed and what's going on at the Treasury. And then, of course, next week, Anthony will be back to help break down not only those developments, but whatever we get in the week ahead. So here goes. We just got the latest quarterly refunding from the Treasury. What that tells us is essentially the kinds of treasuries that they're going to issue over the next quarter, and then what they plan to issue in the following quarter. Of course, these things are always subject to revision. The revision we got this go around was really minor. Essentially, it tells us that in the last 3 months of this year, we're going to issue pretty much exactly the same amount of debt that we thought we were previously. Now, it was also really good to see that in the first quarter of next year, the debt issuance is relatively low. And that matches up with the fact that Treasury tax receipts, revenue coming into the Treasury has done a little better than anticipated. And we've seen outlays or government expenses also a little better than anticipated, meaning they've come in below previous forecasts. So good news there. What really roiled the markets, though, was that within this Treasury document was a statement saying in future quarters, we anticipate additional Treasury issuance. In other words, they anticipate needing to borrow more, not less going forward. That was bad news for bond markets. And unfortunately, it meant a lot of the progress we've made recently on getting Treasury yields down was simply reversed and those yields started climbing again. It's problematic for a couple of reasons. Not the least of which is the fact that these Treasury yields are telling us how much interest, essentially, Scott Bessent is having to pay to refinance the debt. We got to get those numbers down so that we can refinance the debt at lower yields and save taxpayers money. And we're not talking about trivial amounts of money here when the debt is getting close to $40 trillion. We're already spending over $1.2 trillion a year. And again, that amount is just going to go up as those Treasury yields also go up. But another big problem here is the fact that you're having to draw more and more capital away from the private sector in order to finance the public sector. That's going to eat into economic growth because it eats into investment, which is the driver of economic growth. So when we look at the actual mix of treasuries, there's not really much of a story to tell there. At least there's not much of a difference compared to the info that we had in previous quarters. And this goes to the fact that they're having to wait to refinance the debt. This is very much like if you have a bunch of personal debt that you've racked up. Let's say you've racked up a bunch of credit card interest, right? And you need to refinance that debt at a lower interest rate because all those credit cards are 25 or 30%. You're getting crushed on interest payments. Well, what you need to do is you need to take all of that, take all those loans and pay for it with the proceeds from another loan, but that other loan needs to be at a lower interest rate. So it's not that you reduce how much you owe. It's not like a bankruptcy proceeding. But what that refinancing does is it allows you to pay lower interest rate effectively on the same amount outstanding. So if you owe $100,000 and instead of paying a 10% annual interest rate, so 10 grand, if you can get that down to a 5% annual interest rate, now you're only paying 5 grand a year. So you've cut your interest costs literally in half. And if you're putting the same amount each month towards your debt payment, that means you're going to pay off that principal a lot faster. So it's not even just that you're saving $5,000 per annum, but you're actually shortening the number of years that you're actually going to have to be paying back that debt. So maybe instead of paying 10 grand a year in interest over the course of 20 years, maybe you only pay 5 grand in interest over the course of 12 years. So you can see pretty easily how that adds up. What's this look like at the federal level? Well, again, we owe almost $40 trillion, and a lot of that, unfortunately, is at relatively high interest rates, at least compared to where it was 6 or 7 years ago. The problem is that you can't refinance at today's rates because today's rates are still not a place that you want to lock in Treasury debt for 20 or 30 years, which, those are the lengths of Treasury bonds. Notes obviously are shorter, but most of this new issuance coming at us right now is bills. Those are very short durations. In fact, the longest one is only 1 year. It's 52 weeks. And so before we can actually take all of those Treasury bills and lock them in at a very long term, in other words, those 20 or 30-year bonds, we've got to get those interest rates down. Here's where the Fed comes into play. And we talked about on a previous episode, Anthony and I, about the latest move from the Federal Reserve, where they're ending quantitative tightening, something that we flagged for the audience about a year ago, I think it was. And now they're going to relatively soon start quantitative easing. That's going to help absorb some of that new Treasury issuance that the Treasury let us know is coming in the months ahead. But one of the other interesting things coming out of Treasury recently has been, again, something that we warned about, has been their inability to control short-term interest rates. Now, it's not a crisis yet, right? Things are not getting wildly out of hand. But what we're seeing is the fact that they're having so much difficulty keeping interest rates within a relatively narrow range of 25 basis points or a quarter of a percentage point. It seems like they're having more difficulty than they anticipated they would, at least at this point in time. In other words, we're likely to get that quantitative easing even easier than some folks were previously anticipating. It would not surprise me if the Fed actually starts buying more bonds, growing the size of the balance sheet as early as January of next year. That's not an exaggeration. And it sounds crazy because they're only ending QT on December 1. But when you think about it this way, QT and QE, or quantitative tightening and quantitative easing, are a way to essentially not turn a faucet faster or slower. It's the difference between having the faucet on or pulling the drain plug. With QT, you've pulled the drain plug, right? So the water level in your sink is going to go down. But what QE is opening the spigot so that now the water is being added to the sink and it's filling up. So what's been happening with QT, if you want to think of it this way, is that they have had the drain plug out and the water level has been going down. When you put the drain plug back in, that's like saying, all right, we've ended QT. But the water level just stays where it is. And the problem is that where we're at right now, the Fed is already having difficulty. In other words, there are signals that the water level is already too low. And as time progresses, as the Fed wants bank reserves higher, not lower, the water level will continue to be too low. And so again, this is where you can see ending QT, stemming the bleeding, or stopping the water, to use the same metaphor, stopping the water from lowering isn't enough. We still need, from the Fed's perspective, to add more water. And so that's why it's very likely we're going to see sooner rather than later those taps getting opened. That'll help provide some relief on the Treasury front. It'll help bring some of those yields down. But again, these things are not really long-term solutions. And we talked about that in the last episode, how Jerome Powell and his cronies at the Fed have built what's really an entirely new monetary framework it's truly novel. This is not something that existed before March of 2020. COVID was really, in a lot of ways, an excuse that was used to implement this and to force this on the market. Now, the banks have loved it. They're getting, still to this day, they're getting hundreds of millions of dollars, about $400 million a day in interest. It peaked at over $800 million, if I remember correctly. So although we're down by half, this is still a sizable interest stream, and the banks are getting it for doing absolutely nothing. They park money at the Fed. There is zero default risk. The Fed is going to pay them back. They don't have to worry about that. There's zero term premium because it's just an overnight loan to the Fed. The very next day they get their money back. It's not being tied up for any appreciable amount of time. So it's a great strategy for the banking sector. But at the same time, again, you're starving the private market for capital, and you're also starving the Treasury. So although you will get a short-term benefit to the Treasury market because the Fed buying those treasuries is creating an appetite for them. It's increasing demand. And as you increase the demand for bonds, as Anthony would tell you if he was here, that drives the interest rate down. It'll move in exactly the opposite direction of the demand. So you will get that temporary benefit to bond yields, or excuse me, temporary benefit to the Treasury because bond yields are going to drop. But the problem is after the Fed has purchased those securities, what about all the other securities that the Treasury is trying to auction off? Banks don't want to lend to the Treasury, in other words, buy those bonds, because banks are too busy lending to Powell and Company. And the result of that is the only way the Treasury can entice banks or entice private individuals like ourselves to loan money to the Treasury is going to be to offer higher and higher yields. What the Fed has done is effectively created a floor on interest rates. The yields on treasuries can only fall as low as this floor. They bump up against it and they can't go any lower, because if they do go lower, no one would lend to the Treasury at those rates. So this is where, and again, I trust me, I hesitate to get into the profit side without Anthony here. So as far as I'll go is to say the implications here for treasuries and therefore for a lot of other interest rates, because treasuries affect a lot of interest rates and a lot of other bond yields throughout the economy. The effect here is going to be a short-term decrease, but then a long-term increase. So again, Anthony will have much more to say on this next week. And of course, we're going to talk all of the latest developments. We've seen a lot of movement in the labor market. Even though we don't have government data right now, we're getting a lot of private sector data, which again, it's pointing to a great deal of turbulence. We're seeing a lot of layoffs. We've seen a slowdown in hiring. So it's very, very interesting where we are at the moment, because there's a mix of people in government losing their jobs, but we're seeing things like AI cause private sector job losses as well. And you no longer have the robust turnover rates that you had back in the spring, let's say. We also have to deal with the tariff drama as that continues to unfold. We just had oral arguments before the Supreme Court on the IEEPA tariff case, which is the tariff authority that the administration has been using for the most part this year. So we have all those different topics and more to discuss next week. And of course, not just the policy side of it, but next week with Anthony back, we'll get much more into how all of those policies affect the profit side of the equation. So again, I'm EJ Antoni. I play an economist on TV. I'm missing my dear friend, trader extraordinaire Anthony Esposito, but we will both be back next week. Until then.